Hi, good evening, everyone.
Good evening, sir.
Hi, good
Good
evening,
evening,
and
Ankit.
yeah, thanks for joining. So, agenda for today's meet is to carry out revision session for corporate finance towards quiz one, and the format will be that first we'll cover the some basic concepts of week one to week four, or touching that all the concepts and going through the GS, and thereafter we will take the PYQ. And unfortunately, we have got only one PYQ. And before I start, I will like to say a lot of thanks to Abhinit, who has been contributing towards this course, though he's not doing this course now. He did the course in last term. So thanks a lot, Abhinit. Thank you from all the students. And with that, I will start. So I will just share my screen. Okay, yeah. So is my screen visible to all of you?
Hanji, sir.
Yeah, thank you.
Yes.
Yeah, thank you. So this is the document which I have made. So I will go through the. So I'll briefly touch upon the basic concepts and which are likely to come in the next quiz also. So one of the concept in the week one which was covered was that when you make a portfolio and you take, for example, two, three types of bonds and you restructure like that, that one of the bond gets higher rating. And how does it get higher rating? Because its probability of default reduces. So in this kind of question, there is a very important factor is the correlation. So to do that, that the probabilities they change, we have to have that all these bonds are not correlated. And that means this, if you see this Yankee which is there, it has to be zero. If Yankee is one, then it is correlated. And I will come again to this topic. So we will see this question, how this has been structured. And this is from the GA from week one. So the question is, your portfolio consists of three blue bonds. Each blue bond has a face value 100 and the probability of default for each PB is 10%. The correlation between blue bonds is zero. They are uncorrelated. Through securitization, you are able to create three new bonds with face values, a green bond, a yellow bond, a red bond. The face value remains 100. Now, here you have to read carefully. Now, when none of the bonds default, all three new bonds are paid face value of 100. If any one of the blue bond defaults, the green bond and the yellow bond are paid the face value of 100, while the red bond suffers the loss and is paid 0. If two blue bonds default, only green bond is paid the face value, other two are paid 0. In case of all three blue bonds defaulting, none of the new bonds pays off. We are interested in calculating the fair value of the green bond, yellow bond, and red bond. So I will just explain it briefly. So what they have done, they had blue bonds, three blue bonds they had of face value 100, so 1, 2, 3. And their probability, for example, of default was 10%, that is 0.1. Now what they have done the securitization. So they have made three types of bonds in this. One is green bond, another is yellow bond, and the next one is red bond. So if any bond, out of these three defaults, then the red bond which is there, he's the sufferer and he takes the flag. Only the red one will suffer. Okay. Now, if any two bonds suffer, two bonds default, then both yellow and red will suffer. So yellow will suffer and red will suffer, will default. Okay, default. And green will default only when all three will default. So see, mathematically what has happened, the probability of green defaulting has reduced is equal to 0.1 into 0.1 into 0.1. So it has become 0.001. Earlier it was 0.1. So due to this change, now what will happen? That green bond ratings will be higher. So we have seen the ratings. So green will be rated higher. Higher. Okay. Have you understood this concept? How does this securitization takes place? With this, can we go ahead? Anybody can give me yes, if somebody can acknowledge.
Yes, sir.
Okay. So in this question now, we come to basic probabilities. So the first question is, what is the probability that all three blue bond default? So that is 0.1 into 0.1 into 0.1. That is 0.001. What is the probability that none of the blue bond defaults? So that is 0.9 into 0.9 into 0.9, which is 0.729. What is the probability that exactly one of the blue bond defaults? So in that, okay, what we can see, so there are three permutations and combinations. So one is this one defaults, another one is this one defaults, and this one defaults. So total probability becomes 3 into 0.1 into 0.9 into 0.9. So this is for one default. So by doing that, so exactly one defaults, the answer comes 0.243. Similarly, what is the probability that exactly two bonds they default? So this will become 3 into 0.1 into 0.1 into 0.9. So two are defaulting and there are three combinations of this. So we get 0.027. Now, the next question is important, that now your portfolio has the following values. 300 if none of the blue bond defaults. So everybody is paid 100. 200 if exactly one blue bond defaults. So red suffers and you get 200. 100 if exactly two bond defaults. So any two default. So still green bond will not default and he will pay 100. And 0 if all the three blue bond default. So what is the expected value of your portfolio? So see, we have got the scenarios now. So the probability of green defaulting is that when all the three will default, and that we have seen 0.001. So the probability green not defaulting is 1 minus 0.001, that is 0.999. So expected payoff of the green in all the situations is 99.9. So here we have found the expected payoff of green. So we have covered green. Now similarly, we come to yellow. When the yellow will default in two cases, that either two bonds have defaulted, so yellow will default, or the three bonds will default. So in that case also, the yellow will default. So we know the probability of this. This is 0.001. And we have seen probability of exact two defaults is 0.027. So probability of this yellow default is, when we add this, so we will get 0.028. So this is the probability of default. So from here we get probability of yellow not defaulting is 1 minus 0.028, which is 0.972. Therefore, expected payoff of yellow is 97.2. So this we have done for yellow. In the same fashion, we do for red. So for red, okay, the third situation also comes that any one also defaults, then also red will suffer. So exactly one default we had found, it was 0.243. And when we add all these values, so we get 0.271 for yellow, red default. So probability of red not defaulting is 1 minus 0.27, which is 0.72. So now we have got all the values. We know the probabilities also. So we get total expected is expected of this red, yellow, and the green. So expected value is 270. Is this okay? This is steps. Can we do this? Shubham? Anybody pipe up? Just if somebody has not understood, I can cover it again. Okay, so I will take it. Everybody has understood, so I will go ahead. Okay, second question is what is the variance of your portfolio? So variance we know from our earlier courses, it is nothing but expectation of x square minus square of ex. Ex already we have found 270. Now we'll find ex square. So see, probability of 300 that all will, everybody will get paid is 0.729. It means nobody is defaulting, and that's why we are getting 300. So the probability is 0.9 into 0.9 into 0.9. Probability of 200 is 3 into only one is defaulting, rest all are not defaulting, so it's 0.243. Probability of 100 means two are defaulting, one is not defaulting, so it is 0.027. And probability of 0 that we don't get anything, it is 0.1 into 0.1 into 0.1. So this is my mistake. So expectation of x square becomes 0.729 into 90,000, that is 300 square. 0.243 into 200 square, 40,000. 0.027 into 10,000, and this is 0. So this we get 75600. So variance will become 75600 minus 270 square, which becomes 2700. The second follow-on question is to find the standard deviation. We know that we have to take the square root and we can find the standard deviation. Okay. Next question is what is the expected payoff of a green bond across all the states? Already we have calculated that. We have just calculated it is 99.9. For yellow bond also we calculated it is 97.2. Red bond also we calculated it is 72.9. So before we jump to week 2, I will just cover the question which has come in PYQ from this on the same concept so that we remember this. So what they did in the PYQ, they just asked a question just to check the concept, and in that they gave that the bonds are not correlated. So that was the important part. So I'll just come to that question. Okay. So see, this is the question from the PYQ. Your portfolio consists of two blue bonds, each has a face value of 100, same, and a probability of default PB is 20%. The blue bonds are perfectly correlated. So this is a very important word.
सर आपकी आवाज
Hi, sorry, I had just my this internet connection got disconnected. So, am I audible to all of you?
Yes, sir.
Okay, okay. So I will start from there again, from where I at lab. So I see in this PY question, they have given that blue bonds are perfectly correlated with this Yankee is equal to 1. So what is the meaning of this perfectly correlation?
Sir,
It
can you
means,
share the screen?
Yes, sir. Screen is share.
okay, okay, okay. I'm so sorry. I didn't want to do that again. Is it visible to all of you? Okay, very nice. Thank you. Okay. So what is the meaning of perfectly correlated? It means either both will default or none will default. So this is the correlation. So both are correlated. Either both will default with the same probability 20% or none will default. Okay, is that clear? So that is the only catch in this question. So, and the same conditions are there. When none of the blue bond default, both new bonds are paid face value of 100. If any of the blue bond default, the senior bond is paid. The settings are same. So the question in this is they have asked of the junior bond. So see, the probability of nobody defaulting is 1 minus probability 1 minus 0.2, that is 0.8. Probability of both defaulting is 0.2, which remains the same. So here we don't multiply the probabilities because they both are correlated. So expected payoff when nobody defaults, that is the only time when the junior gets 100. Otherwise, anybody defaults, the junior gets 0. So the expected payoff of the junior is 0.8 into 100 plus 0.82 into 0. Because if both default, the junior doesn't get anything. So the expected payoff of the junior is 80. So this is from the PYQ. Is this question understood by everyone?
Yes, sir.
Okay, very nice. So now we go to week 2 main concept. So please, I will request everyone to go through this question again, understand that, because this time also I am expecting that they will ask this kind of question. And this time they might ask that they are uncorrelated. So please go through all these questions of the GS. I'll share this document once this call is over. Okay, so this we have covered. Now we come to week 2. So week 2 important concepts were first one was the compound interest. So the compound interest formula is 1 plus RT is equal to 1 plus R to power T. And if you are given this RT, then this R is also known as annualized return. So in some of the questions, they ask you annualized return also. So remember this formula, basic formula here, compound interest. So these are examples from the lecture. How much would an investment project which costs 100 today and earns 10% each year be worth in 12 years? So we have to straight away use this formula. First of all, we find the compound interest, that what is the compound interest which we have got over 12 years. Use this formula, so we get 2.138. Now this RT, now we use in the normal, our formula, that amount is equal to principal into 1 plus R. So 100 into 100, 100 plus 100 into 2.138. So we get this answer. Okay, so these are from examples only. What constant 2 1-year interest rate would give a 2-year interest rate of
Sir,
50%.
one thing.
Yeah. Yes, yes.
Sorry to interrupt you.
No, no
So
problem.
amount is equal to P into 1 plus R whole to the power of T, right?
That is when you are doing in a compound interest. So in this question, what we have done, we have found the total interest for the 12 years.
Yeah.
Okay. So what we have
So
done,
power time, this is 12 years you have written as a power,
yes,
right?
yes. So you can use that also. Okay. A is equal
So
to
whatever,
100,
yeah.
1 plus 0.1 into 12. That also will give you the same answer.
Okay, okay.
Okay.
Yeah.
Okay. And next example from the lecture is what constant to 1-year interest rate would give a 2-year interest rate of 50%. So here you have to use this formula. So they're saying that 2-year interest rate has come 50%, which is 0.5. So what is 1-year rate? So you have, if you use this formula, you'll get. And how to use this? Either you do that 1 plus r square is equal to 1.5, 1 plus r is equal to root 1.5. In many cases, what will happen? This will not be square. So we will not be able to use square root. So in that case, how to do that? I will just explain a very easy method. So 1 plus, for example, RT, they have given 1 plus R to power 12, for example, and here it is 0.5. So this becomes 1.05 is equal to 1 plus R to power 12. So you either take a natural log or you take the log. So this will become ln of 1.05 is equal to 2 into ln of 1 plus R. Therefore, ln of 1 plus R is equal to ln of 1.05 by 2.
सर
So,
12 होगा ना?
yeah, 12. Okay. So always take this ln. Why? Because now you will get some value here. For example, I've got 0.707, for example, just an example. So now I can use E. So 1 plus R will become E to power 0.707. And then from here, I can find out E to power 0.707 minus 1. Is this okay? This one? Anybody who has not understood this part?
क्लियर है सर.
Okay. very
वैसे
nice.
आई थिंक बाइनोमियल थ्योरम का भी शायद कोई अप्रोक्सीमेशन होता है, अगर ये जो r मतलब 1 से कम हो तो शायद यूज कर सकते
Yes, yes, yes. लेकिन क्या अगर आप इसको करेंगे तो you'll get
Log
an
easy
accurate answer. So use a क्या here catch is only that can use natural log because then only you can use E. Okay. And we'll see okay, there are a lot of questions on this concept in the PYQ also. Okay, we have seen this question. Now consider a project which costs 900 units today, yields 200 units per year for 2 years, then 400 units per year for the next 2 years, and finally requires a cleanup expense. So this is from the present value. So present value concept is that whatever we are getting payment in future. So for example, we have started getting some amount. They say we are getting 5,000 every year for 20 years we are getting, and rate of interest is, for example, 20%. So this investment, some loan or somebody is promising us. So what is the present value? How much should I invest in this? So it is the 5,000 divided by 1.2 plus 5,000 divided by 1.2 square, and it goes up to 5,000 divided by 20 years. So it is 1.2 into 20. So either we can remember the formula which it has been given in the course. It is C by R into 1 minus 1 plus R to power T. Either we remember this formula or you can use, for example, during the quiz, if you forget this formula, then you can directly use the concept of geometric progression. So if I make this as A, then if I multiply or divide it by 1.2, so all these terms which will become, so this will become, first term will become 5,000 by 1.2 square. This will continue up to here, and it will become 5,000 up to 1.2 to power 21. And by subtracting this A minus A by 1.2, all the terms will cancel except this first term, 5,000 divided by 1.2 minus 5,000 into 1.2 to power 21. And solving this, you will get the answer. This can be solved easily. Okay. Present value concept is clear with everyone, or do I have to explain?
Yes, sir, it's clear.
Yeah. Okay. Okay, so we have seen the present value concept. Okay, then there was a question, a very, very important question is about the real interest rate, because this will come in focus in your 4th week also. So remember this formula. This is the real interest rate. So I will call it as 1 plus par is equal to 1 plus R. R is this is interest rate, which is the market rate. And here is the inflation. So if you do 1 plus R divided by 1 plus pi and is equal to 1 plus par, so from here you can get the real interest rate in the market, because your real interest rate also gets affected by the inflation also. There are a lot of questions and examples on the present value concepts, so we can go through that. So there is a question: at a constant interest rate of 10%, how much money does one need to invest today to receive the same amount, 20 units per year, starting next year? So how much we have to invest, that is X. We are getting 20 per year, and they have not given the number of years. So this is a perpetuity question, where this is perpetuity, that for all the years in future we'll keep on getting this. So when we do the perpetuity question, so this last term which is there, which I had explained in the and when you do the A divided by 1.1, so all these things, they get cancelled, and the formula for the perpetuity is very easy. The present value for perpetuity is C by R. So what you're getting payment every time, and what is the rate of interest. So this is the formula to remember. And in case there's a thing that your this amount which is there, this will also grow by some percentage, G%, then this formula converts to present value is C divided by R minus G. Is that okay? Shall we do one example of this, if anybody wants? Okay, so I take it that everybody has understood this. Okay, otherwise the example is here, that what is the value today of a cash flow stream that pays 20 units next year, grows at a rate of 5%, and faces a cost of capital of 10%. So straight away, the answer will come 20 divided by the rate of growth. This is rate of interest is 10%, so 0.1, and grows at 5%, so 0.05. So this will come 20 divided by 0.05, and you take this, and answer will come 400. How it will solve. Already I have covered this formula. Now this was perpetuity was C by R or C divided by R minus G. Now if it is an annuity, annuity means that only for definite number of years you get the payment. So this T denotes that time. So for that, this formula is present value is the payment which you are getting. What is the rate of interest? 1 minus 1 plus R to power T. And in fact, if you solve this equation which I had done earlier, you get the same formula. So in case you forget this formula, just you can use these steps. Is that okay? I hope I'm audible. I'm not getting a feeling that, my voice is reaching you. Anybody?
We can hear you, sir.
Okay. Thank you. Okay. So if anybody wants, I can directly jump to the PYQ also. I don't have any problem. Or if you want to just cover the basic concept, we can do that. Okay, so week 2, this we have seen some tricks, okay, how to solve it. Okay, so present value. Then the next concept was NPV. So NPV is the we invest something and then we get some payments. So what we were doing earlier, we were focusing only the present value. So, but if I know, for example, that I have invested 50,000 in this, then your NPV becomes this minus 50,000 plus all these actions which we were taking earlier. For example, 5,000 by 1.1, 5,000 by 1.1 square, and I'm going perpetuity. So this is the NPV, and we will invest only when the NPV is positive. And in case I have been given 3 projects, 1, 2, 3, I will invest in the project which NPV is the highest. So this is the concept. Is that okay? Okay. Shall we solve this question? This is on this formula only straight away. Suppose David takes part in and wins a quiz. So somebody offers David prize of worth a million units, which will be paid in 20 equal installments of 50,000 per year, starting 1 year for now, and with 1 installment each year for the next 20 years. So we have to find what is the present value, how much he will get. So straight away we use the formula and we find that he will get this much of amount. Okay. Now, there might be some questions in which they might ask you about the half yearly payments. So this is one example. Consider a coupon bond that will pay 1,500 units each half year for 5 years, plus an additional 1 lakh units in 5 years. So in this, the trick is we have to remember these steps. So first step is that we have to find the rate for 6 months. So by using this formula, 1 plus R is equal to 1 plus this is RT, 1 plus RT. So in this case, T is 2. So we have to find this R. We know the rate is 5% per annum. So this is the half yearly rate we calculate. And we use this half yearly rate for these 1,500 units. So this 1,500, this will make a payment 10 times. Because 5 years, 10 times. We use this R here and we will get the present value for the payment of 1,500. And now for 1 lakh, we can straight away use PV is equal to 1 lakh divided by 1.05 to power 5. So we can get the, yes, anybody asking any question?
Yes, sir. How the T become 2 there? 1
Because,
plus R.
yeah, so 5% per annum per year. Okay. And we are paying 6 months. So I have to find here what is the rate for 6 months. Okay. So 1 plus RT is equal to 1 plus R to power T hota hai. This is the formula.
Yes,
So
sir.
I know annual is 1.005. So and I'm doing 2 twice in a year. So it becomes 2.
Twice in a year. Okay, okay, sir. Okay.
Okay. Okay.
Yeah.
Yeah. Okay. So that's how we find. Okay. So if there is any question on the half year one, so please remember these steps. Okay. So these are small normal questions, easy questions. Okay, straight away on the formulas. Then there was a question regarding the slopes. Okay, the question has come in the PYQ also. That this is directly if somebody has done the managerial economics. So this topic used to be there. For example, somebody is earning 100 rupees and he wants to eat fish and banana. Fish rate is 20 and banana is, for example, 10. Rate is, for example, this is R1 and this is R2. So when we make a graph like this, and if I'm having fish here and if I'm banana here, so the graph looks like this. So here it will show that when banana is 0, so rate, for example, they have given here. So when banana is 0, so this will become 100 divided by R1. Maximum we can have fish. Is this okay? And when the fish is 0, it will be maximum banana he can have 100 by R2. And your slope from mathematics is equal to minus y by x is equal to 100 by R1 minus divided by 100 by R2. So straight away we can find the formula. Okay. So similar question is there in the GA. A consumer has income of 100 units which he spends on a bundle of coconut and fish. The price of coconut is 4 units. The price of fish is 10 units. So what is the slope of the consumer's budget constraint when the quantity of coconut is taken on the horizontal? So coconut I am taking here, fish is here. So how do we do that? So we make this for equation that 4C, that is the coconut is 4 units, the rate is C, plus fish is 10. Now this has to be less than or equal to 100. It cannot exceed 100. So from here, then we make this is equal to 0. We find what is the maximum amount of fish he can have. So he can have maximum 10. And here C, we make this 0. So this will become 25. This is 25. Slope is minus 10 by 25 is minus 0.4. Okay, this question number 7 GA, which is there, similar question has come in the PYQ. So let's see this question. You won a lottery and can receive either rupees 60,000 today or rupees 10,000 1 year from today plus 25,000 2 years from today plus 35,000 3 years from today. You plan to use the money to pay for your child's higher education in 15 years. Assume there is a constant interest rate throughout. So how to do this? How to find the rate of interest? So what do? We equate this 60,000 with the present value of the future payments. So we don't know the rate of interest. So from here, when you solve this, you will get the R. So you can take R is equal to 6.81 and then you can find out. Now there is a very important concept. Remember this, that your compounding can happen daily also. It can happen weekly also. It can happen monthly also. It can happen bi-monthly, 6 monthly, yearly also. In case it is happening continuously, it means every second, every microsecond it is happening, then the formula for that is e to power RT. So this is the formula. Please remember this formula. Okay, your output will be, amount will be is equal to initial amount into e to power RT. Is this okay with everyone? This formula? Okay, so I take it has been understood. Question number 9, you invest in a project which assures a constant payment of rupees 15,000 per year. The payment starts from the current year, okay, and continues forever. So it is starting from the current year. So this is the catch, that in the current year also you are getting 15,000 and continues forever. Continues forever means it is a perpetuity question. If the prevailing rate is 15%, then what is the amount of investment you need to make? So present value will become what you have got present. Put the formula for perpetuity, C by R, 15,000 by 0.15, and you get the answer, 1,15,000. This is one question. Please remember this carefully, because this concept has not been covered during the lectures. You invest in a project which assures you a payment of rupees 15,000 starting next year. The payment grows each year at a rate of 5%. Okay, so your this 5,000 divided by, and the prevailing interest rate is 1.15. So 1.15. So this 5,000 is also increasing at the rate of 1.05 every year. So this will become 5,000 into 1.05 square divided by 1.15 square. So this how. And this is the formula for this. So we know we had the formula C by R earlier, 1 minus 1 divided by 1 plus RT. So when there is a growth, you have to put R minus G and you have to put 1 plus G to power T. And this will become, you can take in the same bracket 1 plus G divided by 1 plus R to power T. So this is one important formula. Please remember this in case this comes. Is this clear to everyone? Any question on this? Okay, thank you. Okay, this is a normal question, a straightaway question from the NPV. We can find out you purchased a coupon bond at rupees 75,000. So this is your cash outflow, which pays 5,000 annually for 10 years. So this is an annuity question. You have to put the formula for annuity, which is the formula. And then it pays a lump sum 1 lakh in 10 years. So we have to find this present value also. And using this formula, we can find the NPV. Okay, so I'm just skipping the questions which are of repetitive nature. I will take the only important questions. Okay, so they are all repetitive. Only this question has come. So this is the question which you have to remember. This is about the, it was about the chest here. What all items you can purchase. So here the question will come like this, that assume somebody is earning 100 units in period 1, 120 in period 2. She spends her earning on consumption 1 in period 1 and period 2. The prices of consumption in period 1 and period 2 are the same and equal to 1. A prevailing interest rate is 10%. Then I will explain this concept here. Okay. So see, this is about that you have got 2 periods. One this, another this. Here this person has, for example, he has earned money C1. Here he has earned C2. Okay. And for example, the rate of interest is R. Interest is R. So now he has got 3 options. One option is that consume, for example, M1, M2. So this M1, which is C1 into P1, and take the price is equal to 1. So this will become C1. So consume C1 in first period and consume C2 in the second period. So this is the first option, that whatever you are earning, you're consuming, and here you earn, you consume. Second is that you save C1. So what will happen if you are saving C1, when you go to the next period, the C1 will change to C1 into 1 plus R due to the rate of interest. Is that okay with everyone?
Yes, sir.
So in the next period, he can now consume how much? C1, 1 plus R plus C2. So this is the second option. Third option is that in the first period, he will borrow. He will borrow, and how much he can borrow? He can borrow only C2 divided by 1 plus R. This is the actual value of the C2.
Yes, sir.
And then he will consume C2 divided by 1 plus R into C1 in the first period. So I will tell you some formula just to remember. This was the concept. One is that when you make the graph for this, the slope of the graph is minus 1 plus R. So remember this formula. Okay. And in the same breath, I will say that if we are considering inflation also, then the slope becomes minus 1 plus R divided by 1 plus pi, where pi is the inflation rate. So just for the quiz part, I can remember these formulas. There can be some questions on the same concept. And using this concept, they can ask you that how much maximum he can consume in the period 1, how much maximum he can consume in period 2. So remember these concepts only, that in the period 1, if he saves everything, then in the period 2, this saving which is there, it will get multiplied by the interest rate. So he will have higher amount. And then sum it up with the C2. So that will be the amount. Maximum amount to spend in period 1 that you borrow. So how much you can borrow? You can borrow only C2 divided by 1 plus R. So this will become your maximum which you can spend in the period 1. Is this clear, okay, with everyone?
Yes, sir.
Okay, very nice. Thank you. So I've covered. So now we come to the week 3. Week 3, first is the Gordon growth model, which says if we know the dividend, if any share is paying the dividend, we know the interest rate, we know the growth of this share, then we can find the share value. The share value is dividend divided by rate minus growth. So this is very, very similar to the formula of perpetuity. So instead of C here, we are using D, D over R minus G. So by this, we can remember both formulas. Second is IRR. IRR, when do we use? So till now, what we were doing that I am getting a payment and I was knowing that there is an interest rate of 10%. So I was doing this. So suppose I don't know the interest rate. I know only the, my how much I have invested and how much I will be getting every year. For example, if I give you an example that I invest 50,000 rupees in some project and then I get 5,000 every year for next, for example, 30 years. So what is my rate? Okay, so that I can calculate by IRR. So for this, I don't require anything. I don't require market interest rate, anything. And IRR, how do we calculate? What do we do? I do this 50,000. This is an investment. So this is minus 50,000. Plus I take 5,000 plus 1 plus R. And this R is the IRR. Plus 5,000 divided by 1 plus R square. Plus I go till 30 years, 1 plus R to power 30, and I equate that this, if you remember, this formula was for the NPV. I equate this equal to 0. So this, if it is more than 3 years, 1 to power 3, then in the quiz we cannot calculate. In fact, mathematically, by hand we cannot calculate. We can calculate only up to 1 plus R square quadratically. So there's an Excel methods in which we can calculate. So now I'll tell you some things that if there is a project in which NPV is higher, but IRR is lower. So what should we do? Anybody can tell me on this?
Yeah, I think IIR should be greater than the prevailing interest in the market. Then we should take up the project.
Yes. So, but remember that always NPV is always higher than the IRR. Remember this. Oh, we will give more weightage to the NPVs. Is that okay?
Right.
Okay. In case there are two projects which NPV is similar, it is also NPV is 3.2. This NPV is also 3.2. Then I correlate the IRR for both. And then I see which IRR is higher, then I'll go to that. Okay. But if, for example, here it is 4.5, it is 3.2, and here IRR is 2.5, and this is 3.5, I will take the project with the higher NPV. This is the thing. Okay.
Sir, NPV is, hello.
Yes.
Sir, NPV is same like that, whatever amount, present value of whatever amount we are investing, minus the present value of the value invested.
Yes. So it is the net present value.
Okay, sir.
Okay, so if you take the NPV formula, NPV is your minus, this is your initial investment, 50,000. So this is your initial investment, and this is your present value.
Okay, sir. Of total return.
Yeah.
Thank you.
Yeah. Okay, then we go to the next part. Okay. So we have seen these parts. This is from the straightaway formula. Then there is a concept called PI and the payments. So there is a question in the PYQ also. So you have to find, for example, PI. So PI is nothing. It is the present value of future cash flows cash flows divided by minus first cash outflow. So if you take this formula, for example, minus 50,000 plus 5,000 divided by 1.1 plus 10,000, I'm taking different 1.1 square plus 5,000, 1.13 plus 7,000, 1.14. So this part which is there, this is the future cash flows, this total. And the first cash flow is this one, minus 50,000. So when you divide this part by minus of this, you get the PI. So like IRR, PI is also used when the NPVs are similar to take a decision. Otherwise, always your NPV will always have the highest weightage to take a decision about the project. Is that okay?
Yes, sir.
Yeah.
Okay. Another thing, it is not possible to find or calculate the PI if there is no cash outflow, because in the denominator there is a cash outflow. So this is the second part. Okay. So you cannot calculate, you cannot find PI always. Okay. Similarly, for the IRR also has got the conditions. In many cases, like in the quadratic equation, there are many quadratic equations where we cannot find the real roots. So similarly, in the IRRs, when we are solving for a quadratic equation, there might be the cases where we cannot find the IRR. So remember this, it can come in objective kind of question. Okay, so I have covered these main parts. Okay, so I will straight away jump to the PYQ now. Okay. Week 4, these are formulas. Please remember this. Very easy formulas for a duration. What is known as a maturity? Maturity is the last day when you make the payment. Is the last day for the payment. For example, there is a project which is paying 50,000 in 5 years, 1.215, and it is paying 1 lakh after 10 years. So maturity of this will be 10 years. So it is paying the last day of the payment is known as the maturity. The duration is, formula is the payment divided into time divided by summation of the payment. So in this case, it will become 50,000 into 5 plus 1 lakh into 10 divided by 50,000 plus 1 lakh. So this is the formula for duration. There are certain other formulas also for like CPI formula is given here. Nominal GDP is calculated using the current prices, whereas the real GDP is calculated when you take a base year. You fix the prices, so real GDP gets affected by the production. So these are the things, theoretical, easy ones. This formula already we had seen in week 2. This is the real interest rate is equal to 1 plus R divided by 1 plus pi. Okay, so from here, I will go to the PYQ. If anybody wants to ask any question, he or she can ask me. Till now, any theoretical part, any conceptual part. Or shall I assume everything is good? Hi Vivek, good evening.
Yes, I find everything to be good till now.
Yeah. Okay. So now we'll go to PYQ. PYQ, fortunately, in comparison to GAs, PYQs I found slightly easier. So, okay. So the first question is, consider a bond which pays 500 units in 5 years and 1,000 units in 10 years. What is the maturity and duration of the bond? So just now I covered. So maturity is the last day when you get the payment. So last payment when we are getting in 10. So maturity is 10. For the duration, the formula is payment time summation of the payment. So here, if we apply this formula, this will become 500 into 5 plus 1000 into 10 divided by 500 plus 1000. And you solve it, you get 8.33%. So this is the duration. Is this okay? Can I go ahead here? If anybody wants to ask me any question on this, Jalaj, Vikas,
No, you can go ahead.
Yes,
Arjun.
sir. Yes, sir. It's fine.
Okay. Okay. So next question is, the table below relates to the economy of some Gala land where the typical consumer market basket contains 2 clothes and 3 burgers. So this is the consumption. He consumes 2 clothes and 3 burgers. In 2017, this was the rate. In 2018, this was the rate. 2019, this was the rate. So the question is that if the base year is 2017, then the economy's inflation rate as measured by the CPI in 2018 is what? So how do we calculate this? What do we do? We find the amount spent in 2018 minus amount spent in 2017 and divided by amount spent in 2017 because the base year is 2017. So in 2018, his consumption remains same. Cloth is 2, rate has become 300, burger has become is 3, but the rate has become 50. Minus for 2017, it was 2 into 400 plus 3 into 30 and divided by the same. So when you do this, it will become 750 minus 890 divided by 890. So here you get answer in minus. So it is minus 0.157, which is 15 minus 15.7%. So your inflation rate has become negative. So inflation has not increased, it has decreased. Why? Because due to this main thing, from 400, the rate has decreased to 300. So this is also known as deflation. Is this clear? Okay, this question? You can solve it. How to find the inflation rate?
Yes, sir.
Yeah.
Okay, very nice. Okay, so next question, like I had mentioned earlier, to remember this formula, that assume Shyam earns rupees 10,000 in period 1, 12,000 in period 2. He spends his earnings on consumption in period 1 and period 2. So this is one period, this is another period. The prices of consumption in period 1 and period 2 are the same, equal to 1. If prevailing interest rate is 10%, then the slope of the intertemporal budget constraint is what? So if you remember, I had discussed this. So the slope of this intertemporal, remember this, is 1 minus 1 plus r. And in case inflation is also there, then the slope will become minus 1 plus r divided by 1 plus pi. Okay. So using this formula minus 1 plus r, straight away we get minus 1.1. Is this okay with everyone?
Yes, sir.
Okay. So next question is again on the same concept. The current average price level of goods in the economy of Godzilla is 80 units. So this is the price level. The prevailing nominal interest rate is 10%, or if the expected price level in the next period is 90 units, so price has increased, then what is the real interest rate? So real interest rate formula is 1 plus, you can call PA, is equal to 1 plus R divided by 1 plus pi, where R is the nominal interest rate, pi is the inflation. R is given 0.1 in the question, but inflation rate we have to calculate. How we calculate? It has become 90, earlier it was 80, so inflation rate will become 90 minus 80 divided by 80. That is 1 pi divided by 8, 0.125. Put this in this formula and you will get the PA value. So PA value comes around minus 2.33. In the questions, okay, they have given multiple choices. So closest to minus 2.33 is minus 2.5%. So remember these steps, how to calculate, and this formula. Is this okay? Can we go ahead?
Yes, sir.
Okay, finished. Okay, a company with AAA bond rating will command a higher interest rate on its bonds than a company with lesser BBB bond rating. So just to cover certain basics here, that see, any bond which is considered lower risk, it will have lower interest rate. It is not offering very, very high with this. Any bond which is having higher risk, always remember, higher risk will always have higher interest rate. Okay. Now see, correlate now this. If it is having a lower risk, its rating will be higher. For example, triple A. Where if it is having higher risk, its rating will be lower. So it will be like somewhere BBB. So correlating this concept, now you can see the triple A bond rating will command a higher interest. This is wrong. So this is an incorrect statement. So answer will be, for this will be false. Is this okay? Clear with everyone?
Yes, sir.
Okay. Okay, this question already I had discussed when we were discussing week 1. So remember, only in the question you have to see this correlation. If it is correlated, the entire connotation of the question changes. Okay, so I'll request everyone again to go through this question of week 1 GA and this question especially to understand that. Similar question can be expected in the feedback in the next quiz. Okay, next question. What is the term for a graphical representation of the relationship between interest rates and the maturities of the debt securities? So this is from week 4 and we know the professor had covered. This is known as yield curve. And studying the yield curve, we find these values which are there, which we can use for our analysis. What should be the rate of interest per year so that your money triples in 15 years? So here we use the formula 1 plus R to power RT is equal to 1 plus R to power T. So here you see your money is tripling. So your effective rate of interest is 2. This is becoming 3. You put in this R to power T, and I had told you this method how to use it. So you take the natural logarithm. So this will become, I'll tell you the shortcut, R will become e to power ln 3 divided by T. So T is 15 minus 1. You calculate this and you'll get the answer 7.6%. Is this okay with everyone, this formula, or shall I explain it here, these steps?
Yes, sir. Clear.
Okay, so use the natural logarithm, then only you'll be able to use this E. So don't use that log. Okay?
Yes, sir.
Okay. Next question is from the present value, easy question. An investment is expected to yield 3,000 in 3 years, 5,000 in 5 years, and 7,000 in 7 years. Rate of interest is 10%. And what is the present value? So we know the formula PV is equal to 3,000 by 1.13, 5,000 1.15, 7,000 1.17. Do mathematics, use calculator, and we get the answer 8951. Okay, this is an interesting question. Again, you have been depositing money at the end of each year. So this is the language they've used. Into an account drawing 8% interest annually. What is the balance in the account at the end of year 4 if you deposit the following amount? So see, we make, so they are asking end of the year 4 and you are depositing at the end of each year. So this is 1 year, first year, this is second year, third year, fourth year. So you deposit at the end of first year 35,000. So this will take interest how many? 1, 2, and 3. So we get 35,000 into 1.08 to power 3. Then we invest 50,000. It will take interest only in 2 periods. So plus 50,000, 1.08 square. 72,500, it will take interest only once. So 1.08. At the end of year, fourth year, we are depositing 40,000. So no interest. So there is no interest. So just use calculator, find the answer, and we get the answer. Is this okay?
Yes, sir.
Okay. Okay. Which of the following statements is about bubbles is correct? So when do the bubbles happen? That when the share market suddenly some share goes high without any valid reason, okay, and then it is a bubble in the market, and then it crashes. Okay, so why does it happen? So a bubble occurs when the fundamental value of a share rises too quickly. So this is false. If a fundamental values, they have started some new project or they have done some innovation, so it will increase. So it is not a bubble. Second, a bubble is less likely to occur in a market where people can easily switch from buying to selling. This is false. Bubble happens when it is very, very easy from buying to selling, because see this part here, the people have started selling. That's why this bubble has broken. Okay. And bubble happens when the buyers create the bubble, not the sellers. So here they are saying sellers. Third, momentum trading strategies make bubbles more likely to occur. Yes, without any reason, everybody just creating, we are purchasing without any change in the fundamental value of that share, only on the momentum base. So we are creating a bubble, and one day that bubble will burst. Okay. So the third option is correct. Fourth, a bubble can never occur in a financial market as trades take place every frequently. This is false. We know that the bubbles have been created. We have seen housing bubble in USA, tech bubble again. And if you analyze the share market, then every 10 to 15 years there is a bubble in the share market. Keeps on happening. It is an inherent part. Okay, next question. Suppose an asset earns an annual interest rate of 8%, which is continuously compounded. So this is from the e to power RT. If asset sells for 100 units today, what will be its value after 2 years? So the formula is for that. Whatever you invested, you do e to power RT for continuously compounding. So you apply this formula, you get the answer, 170. Is this okay? We had discussed this earlier also.
Yes, sir.
Okay. Okay. And next one, what is the present value of cash flow stream that pays 3,000 next year, grows at a rate of 3% per year thereafter, and faces a cost of capital of 9% per year? So see what they have given. They have not given any year. So this is a question of perpetuity. They are not given any number of years. So it is getting paid every time. So formula for perpetuity is C by R minus G, where R is the rate of capital, G is the growth. It is 3%, so it becomes 3,000 divided by 0.095 minus 0.03. So this becomes 50,000. Next question is, you discover an antique in your attic that your father purchased 30 years ago for rupees 400. So this is your C0. You auction it and receive rupees 80,000 for this item today. What is the annualized rate of return? So annualized rate of return means that what is the rate per year. So what do we do? First we find RT. So RT will become 80,000 minus 400 divided by 400. So this is your RT. Then we use the formula 1 plus RT is equal to 1 plus R to power T. So this RT we have calculated. So this is come 199. Use this 1 plus R to power 30, and using the same natural logarithm and use the E, we get the answer 19.32. Is this okay?
I would like to add more.
Yeah.
Here, the annualized rate of return itself becomes the IRR. So you can find it directly.
Okay. Okay. Next one, you believe in the power of compounding and decide to save rupees 100 per day by avoiding the junk food. You deposit the rupees 100 at the end of each day in a bank account that pays 8% annual interest compound daily. How much money will you have in 5 years, assuming 365 days per year? So see in this question, what are the main points which you have to take? That you are depositing every day, number one. Number two, your compounding is also happening daily. So what you have to do, they have given a hint also, use banking convention. So your day rate, every day rate will become this annual rate which is there, 8%, which is 0.08 divided by 365. So this is your rate day. And then you have to use this formula. This is is also known as recurring deposit formula. A is equal to 100 divided by R into 1 plus R to power T minus 1. So see, R will become, R is a very, very small figure when we have calculated. Your T now will become number of days. So in 5 years, you have got 5 into 365, 1825 days. Put this in formula, use calculator, and you will get the correct answer, which is 224365. Is this okay? So this is another formula which we have to remember. Any doubt, anyone?
No, sir.
Okay, very nice. Okay, so I think we are reaching the end. So next question is LIC stock is trading at rupees 400 today. The LIC is expected to pay dividend of rupees 30 per share per year. If the growth rate of LIC dividend is 4% every year and appropriate rate of return is 10% per year, then according to the Gordon growth model, either it is underpriced or overpriced. So the Gordon growth model says the price of the share is equal to dividend divided by R minus G. And this is very, very similar to your perpetuity formula. In perpetuity, we use C by R minus G. So when you put this in formula, you get 30, 0.1 minus 0.04, which comes 500. But the rate presented is 400. So as per this formula, Gordon growth, this share which is there, it is underpriced. So the investor should buy the LIC shares. Is this okay, this formula?
Yes, sir.
Okay. Okay. Next question. Suppose an investment costs 5,000 rupees today and pays off rupees 3,000 in next year and rupees 4,000 in 2 years. What is the internal rate of return? So we know how we find IRR. You put it 0 and you put the same NPV, that formula which is there. And now you solve this quadratic equation. So it will become what has happened, that all these 3 zeros have cancelled. This 1 plus R square has come here, minus 5, 1 plus R square plus 3 into 1 plus R plus 4 is equal to 0. Change again this minus to plus 5. So when you do this, so here remember the final step which is there. You will never take IRR negative. IRR, you will never take the negative IRR. So always you will take the plus IRR. So it will become plus 89 minus 7 by 10. So discard the other root which is there, which will come negative. So from there you get the answer. Is this okay?
Yes, sir.
Okay. And like I had mentioned earlier, if it comes, for example, for the third year, it comes 1 plus R cube, then, humanly it is very, very difficult to solve this. Then we have to use either Excel or we have to start or write a Python code, small Python code. Okay, so we go to the next question. Which of the following statement is correct regarding internal rate of return, IRR? Number 1, the internal rate of return can be computed for every type of project. No. So we have seen, for example, this is a quadratic equation. There are many quadratic equations where we cannot find the roots. Real roots are not possible. Okay. So similarly, the IRR cannot be found for every project. Number 2, internal rate of return can never be 0. This is also false. It can be 0. Every project has a unique internal rate of return. No. We have seen this is a quadratic equation, so we can have even fact 2. In case we had this R2 power cube, we could have 3 IRRs also. The last option is the IRR capital budgeting rule may give different answers than the NPV capital budgeting rule. So this we had discussed earlier also. This is a yes. And in case they ask, to whom we will give weightage? To NPV or to the IRR? Anyone?
NPV.
Yes, NPV is the first one. Okay, the next question is on PA. There is a project which requires an initial investment of 500 units today. Project will pay off 500 units after 5 years, 500 after 10 years, and 500 after 15 years. If the prevailing constant interest rate is 10%, then what is the profitability index of the project? So PA is defined as the present value of the future cash inflows divided by minus into first cash outflow. So for PI is very, very important that there has to be cash outflow. Otherwise, you cannot calculate PI. So you find the PV of the future cash flows by using the formula. So the answer comes is 500 into 125. I had calculated this. And then you divide it by minus into minus 500, which becomes plus 500. So this becomes 1.25. This we can do it easily. So
Yes, sir.
if you see like what Abhineet had mentioned today in the WhatsApp group, your basic formula remains the same, and you keep on building your concepts around that formula. Okay, so your basic formula is the present value formula. In that, you deduct the initial investment, you will get the NPV. You put the IRR and then NPV, you make NPV is equal to 0, you get the IRR. So remember this formula. And in case that annuity formula, if you forget, then I have told you how to solve it. Okay, so we can do it quickly.
Just a small doubt in this profitability index question.
Yeah.
Here in the denominator, we always consider the first cash outflow, or
Yes.
or if there is a project where you require some cash outflows in the some middle period or at the last. So
As
do
per
we
that,
consider?
as per the definition, I'll just go to the lecture. I think it is from the week 3.
Yeah.
Okay, so week 3, I can go before we shoot. We can take this question only. It's a playback tool also. So profitability index here. So here, okay. So see here they have given here this. So the profitability index can give the correct answer in the situation involving one negative cash flow followed by all positive cash flows.
Right.
Okay.
Right.
Okay. So and here also they have written. Note that the profitability index is meaningful only if the first cash flow is a cash outflow. So that is the significance of your first cash outflow. Okay.
Yeah. Okay.
Yeah. Okay.
In fact, can I add something here, Lalit?
Yeah, Vivek.
Your
Hi,
permission.
hi, how are you?
Good, good.
Yeah.
In fact, if you see this IRR, it is basically a polynomial equation, like you said, when you are doing with, So if there is any change of sign, if you have a negative and then positive, then another negative. So number of change of signs in a polynomial equation, there is something called a Descartes rule of sign. So you get 2 positive roots. If there are 2 sign changes, you get 2 positive roots. So that's why when you have any change of sign, you never calculate even the IRR, because it'll give to misleading, equations.
Yes. Thank you, Vivek.
Not at all.
Yeah. Okay. Next question is about the payback. So just to give you what was covered in this lecture, unfortunately, in the lecture, they don't build the sequence. So what they said, how to decide about a project. So first, how to decide? We take either the NPV. Now, second is if NPVs are similar, we find the IRRs. Or IRR is also used when we don't know the rate of interest. Okay, we know only the inflows and the outflows. Then we use the profitability index also. Profitability index, it is used when NPVs are similar. Then there is another case, some yardstick to take a decision about a project is about the payback. Payback means that how fast I get my capital back. How fast I get my capital back. So these are some measures, but if you ask me and what I've understood from the lectures, the highest weightage will always go to the NPV. Okay. Am I correct, Vivek, in this? If I say that?
Absolutely, absolutely.
Yeah. Okay. So the last question is about the payback only. A financial advisor tells you that you can become a millionaire if you start investing early. This I think we had done. Okay. No, sorry. Yeah, we were here. So consider the following three projects which have initial cost of ₹1,000. So this is my capital I've invested. Project 1, it pays out 500 next year and ₹1,000 2 years from today. So what will be the payback time for this? So out of 1,000, I have got 500 in first year, 1 year, and then 1,000 in next year. So my next 5,500 has come in 6 months. So my payback of project 1 is 1.5. Is this clear to everyone?
Yes, sir.
Okay. Now project 2, it pays ₹100 starting next year and pays the same amount for 50 years. So if you see 100, how many years it will take for 1,000? 10 years. So here payback is 10 years. Project 3, it will pay 4,000 5 years from now. So I'll get ₹1,000 my capital back, but after 5 years. So which is the best project for me if I apply the payback rule?
Sir,
Or the
but
least-
you are taking, like, in first case you are saying that 1.5 years, you are dividing 1,000 years in two parts, right? Then
Yeah.
you are saying 1.5. But in project 3 you are saying 4,005 years from today, so you get 1,000. Then
So
here you are not dividing.
till 4 years I have not got anything, na?
Yes, sir, I'm getting your point. But in case 1, you have divided that 1,000, right? For saying like 1,000 2 years from today. So you are
Okay.
saying that 500 I will
Okay.
get in 6 months.
Okay,
Right.
so for this question, again, just make it 2 also. Then also this project 1 will be the best.
Yes, sir.
Has the most? Okay.
Yes, sir.
But if you see there is one GA question, you revisit that question. Okay, and there you will get that how it is calculated.
No, sir, I'm talking about project 3. Why you are not then dividing that amount in like you are doing in project 1? They're dividing the amount in
Okay.
means halfly.
Okay. 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 Next question. A project earns a total of 50% return in 2 years. So this is the return. This is 2 years. If annual return in the first year is 30%, then what is the annual return in the second year? So this is the formula 1 plus RT when you got different rates in all the years. So this is 1 plus R1, 1 plus R2, 1 plus R3, so on. When you got different rates. Okay, so in this case, there are only 2. So this will become 1 plus 0.5, which is the 2 years return. First year return is 30%. So this is 1 plus 0.3 into 1 plus R2. You solve this. 1 plus R2 becomes 1.1538 and R2 is 15.38, which is 15%. Is this okay? This formula?
Yes, sir.
Okay. What is the annualized rate of return? Annualized rate of return is always this one. Of the investment of 100 units that promises to return 200 units in 10 years. So 200 units means this is 1. It is becoming double. So you put here 1 plus R to power 10, use again natural log, and you get the answer. So the tip is always use natural log, not log. Okay, now I think we have come to the last question. A financial advisor tells you that you can become a millionaire if you start investing early. You start to deposit 25,000 units every year in a saving account which earns 8% annual interest. What is the earliest year at which your account balance reaches 1,000,000 units? So here it is annual interest. So we calculate this and straight away we use the formula, same formula which I discussed earlier, recurring account. So your amount will become C by R into 1 plus R to power T minus 1. R is given and we have to calculate T. Everything else has been given. So we calculate this, again we use the log and the T comes 18.64, which is close to 19 years, and 19 is the answer. With this, I have finished PYQ. Any addition, any suggestion, any query, or any doubt anybody can pipe up? I would be glad to answer that.
Sir, for the
Yeah.
last question,
Yes.
you used the different formula for calculating A, right? C upon R into 1 plus R to the power T minus 1. So, is there any a keyword or something like that in within a question so that we can change whether it is a recurring?
Yeah, if it is a
Formula.
recurring one, if it is a recurring one, because why? Because you are depositing 25,000 every year.
Okay.
Okay.
So it is not the first payment, but each and every year we are keep on continuously paying that.
Yes, yes. So you are paying every year. So it is like a recurring account which you have got in the banks.
Okay, okay, got it.
Okay. And for the recurring, always remember this formula: C by R into 1 plus R to power T minus 1. This is the formula. Okay.
Yes, sir. Thank you.
Future value of annuity, right? Yes.
Future value of?
Annuity.
So future value of annuity, but when you are doing taking that annuity once only or regularly, periodically?
Periodically.
Okay, so that also becomes a recurring account only.
Right.
Okay. Yeah. Any other question? Okay, so if there is no question, thank you, Abhinay, for joining, and thanks a lot, really. It is very, very, I really appreciate it. Thanks a lot. Thank you, Vivek. Thank you, Jalaj, Harshit,
Thank you
Anu,
so much.
Vikas.
Thank you so much.
ये please वो upload कर देना.
Yes, yes, definitely.
Yeah.
I'll upload this document also, and I'll upload this video also on my YouTube channel. Okay.
Thank you so much.
Yeah. Bye bye. Thank you, Abhinay. Bye bye. Bye. Have a nice day. Bye bye.